Let's get right into it. So a lot of times we talk about the S&P being the proxy for the broader market. I've heard other people like Josh Brown talk about maybe the NASDAQ should be what we look at to represent the market. But you believe it's really the Russell 2000 that represents the recovery.
The Russell 2000 really has emerged as the reopening of our economy benchmark because it is a very, very broad indicator of stocks. It's 2,000 stocks, and there are no major heavyweights the way there are in the S&P and the NASDAQ. So, yes, I think it's a very broad proxy for what's happening in our economy as the economy improves.
So the Russell 2000 year-to-date still down about almost 5.5% right there. What are you expecting for the back half of the year as people go back to work and maybe even in some cases go back to school?
Yeah. As the economy accelerates, we're already starting to see that in interest rates beginning to tick up with the 10-year Treasury crossing, 0.7%. And also, I think we cannot minimize what the Federal Reserve just said. They're committed to keeping interest rates low and liquidity very much in place, which bodes well for higher inflation down the road. Small cap stocks do extremely well in that kind of an environment. I'm not saying you can pinpoint the day or the week that this is actually going to start turning around and the Russell's going to begin outperforming under other benchmarks, but the seeds are in place for that to begin to happen. It's already begun on days when we have positive news like we just had last week with Abbott's announcement of a low-cost COVID test. We see much better breadth in all the indexes, and especially the Russell 2000 benchmark.
You know, Dan, the market's gotten a lot of strength from tech and consumer discretionary. A lot of those names are actually in the Russell 2000 as well. Do you see them continuing to have that same strength as we go forward?
I do, and I see it broadening out into the industrials and the materials space as well. Consumer discretionary, as you mentioned, did extremely well in the more recent period as, retailers are doing much better and other businesses that require, people to spend money. So, again, we're ready to reopen this economy. As the technology gets better, one or two things. We're either going to whip this thing through vaccines and other therapies, or we're going to be able to just coexist with it much better, which will have much less of an economic impact than it has had over the last several months.
So, Dan, when you said we're ready to reopen the economy, who exactly are you talking about? Are you saying the consumer is ready to reopen it, or are businesses also ready to reopen? Because just last week, we saw a number of companies ready to lay people off.
Yeah. Well, that's an unfortunate byproduct of adjusting the businesses to what current demand is. Hopefully, as time goes on, those businesses will begin rehiring people that they've perhaps been forced to lay off more recently. But I see more positive economic. This is going to be a big recovery quarter, whereas the last quarter was the worst. This is going to be an extraordinarily strong quarter in the third quarter. And let's hope that momentum continues as we get closer to the end of having to deal with this pandemic.
So you mentioned that Jay Powell's comments are an encouraging sign for small caps and mid caps, but what about those rising bond yields? Is that maybe a sign that people might be ready to go back to saving as opposed to putting their money in the markets?
At 0.7%, it hardly is a terrific place to put your money away into because your returns are just going to take so long to generate. I think you're going to see gradually higher interest rates, a gradually steepening yield curve. That's also positive for financials, namely the banks. And as that improves too, we'll see as things go along. But remember, the banks, they've underperformed this year. Industrials have underperformed. And whether you're looking at the Russell 2000 or even the S&P, a handful of the mega cap weighted names in the index really doesn't tell the whole story of what's going on in the economy. It's a lot of stocks that have not moved. They're either flat or down considerably for the year. There's a lot of catching up to do.